Hello, good day. So our topic for today is partnership liquidation as the continuation for our series in the partnership. And we are on our part 1, LUMPSUM liquidation. And God bless you all. Sorry for it took me quite so long to record for another video. So let's proceed. So our learning objective for this topic is number 1, definition of the partnership liquidation. 2, causes of liquidation. 3, two types of liquidation, realization of asset, and distribution of gain or loss on realization. And lastly, payment to credit. So, liquidation of partnership. Take note that normally under liquidation of partnership, we usually associated this one with the dissolution. But take note, dissolution is a mere diluting of the P&L ratio because additional partnership would come in or would get out of the partnership. Whereas in liquidation, it marks the ending of the partnership agreement, meaning it's the cessation of the partnership, or it is when the partnership will no longer operate on the day-to-day basis, or no more transaction for the partnership except for the payment of the creditors, and the remaining money should be distributed among the partners. So the parties involved sell the properties the business own. So in here, all the non-cash assets are now converted into cash so that they will be able to pay the existing creditor. Take note, the existing creditor could be the partner themselves or the outside creditor. And the order of payment should be first paying the outside creditor because they are normally don't have any interest within the partner, unlike the partner itself, who would usually manage the partnership. Next, each partner receive a share of the remaining money. So take note, whatever the balance of the money will now be distributed among the partners as they are the non-priority creditor. Next, the company's bookkeeping record include the total amount in this account adjusted for distribution the partner receive, additional investment, and partner share of losses. So normally, what if there are still a positive cash, it will be distributed among partner. If none, or a partner would have a deficit balance or a negative balance, the partner would be required under the law to make additional payment. But in the event that this partner is insolvent, meaning no more assets to be contributed to the partnership, then the other partner who is still solvent would make additional contribution, and the two would just settle it in further in the future. And then the partner share of the company's losses. So normally all the shares of losses or whatever losses from the selling of the non-cash asset would be shouldered by the partnership, as well as the liquidation expenses. So, winding up and liquidation. So, take note, usually, under liquidation, we winded up the partnership because we would want the partnership to be closed so no more assets and liabilities would be remained. So, winding up and the liquidation of the partnership begin after the solution of the partnership. In here, where the partner decided that they will no longer be partner or will not be able to continue the operations. So, liabilities to partner or loans they made to the partnership have the same status as the liability of the third party creditor. So, normally, the liabilities to partner could now be offset when there are deficit balance, and these are also needed to be paid by the partnership. Next, as part of the liquidation partner, each partner with a deficit in his or her capital account is required to make a contribution to the partnership to remedy the capital deficit. So normally in this one, when a partner, remember we have two types of partners. We have the solvent and the insolvent. The solvent would still have the asset to contribute additional money to the partnership, whereas the insolvent partner are those who cannot anymore contribute additional capital. So in this event, under the law, even the limited partner are still required to make additional contribution to shoulder for the deficit of the capital, and that the partnership will be able to pay its outside or external creditor. Okay? So there are two kinds of liquidation. We have the LUMPSUM liquidation And under LUMPSUM liquidation, it's no distribution are made to the partner until realization process is completed when the full amount of realization, gain or loss is known. So meaning, no distribution among partner unless all the assets are fully liquidated and all the creditors are fully paid, and whatever remain would now be distributed among the partnership. And for this discussion, we would focus on the lump sum liquidation. Next, we also have the installment liquidation. Installment liquidation is a process when the distribution are made to all the partner as the cash become available. So for this one, we would be learning about the cash priority program, who among would receive the first cash, who among would receive the whatever remains to the partnership after all the assets or certain assets are being sold and paid and the creditor has been paid. So usually this one is staggered because normally it was quite hard to liquidate an assets, especially nowadays during the COVID, because not so much people would be buying the asset of the partnership. So that's why there are also installment liquidation. Okay? We will have additional video for that one. So we have LUMPSUM liquidation procedures. So number one, books should be adjusted. Adjusted to what? Adjusted to their fair market value, meaning all the assets should now be revalued to the amount of fair market value so that they will be able to determine what are the gain or loss on the realizations of the assets. So we usually close all the income statement or the nominal account. So what remain is only our real account or the balance sheet account. So all non-cash asset is now converted into cash. Any difference in the book value and the amount of realization should be divided among partners. So take note, if an asset is sold, for example, if the computer is fair market value or the book value is 10,000 and it was sold for 20,000, the gain would now be divided according to their P&L ratio. Or if it's vice versa, meaning there are some loss, so the loss are now divided also among the partnership according to their profit and loss. If it results with the deficiency balance, it can be eliminated by the following. So if there are deficit with the balance of the capital and the partner are solvent, then that partner will be required to make additional cash investment so that they would be able to pay for the difference. Or in cases that the partner is insolvent, the deficit will now be charged as additional loss to the remaining partner. Okay, but we would have examples so that it would be clearer. So next we will now, after all the non-cash assets are converted into cash, then the partnership will now pay any liabilities of the partnership. But the priority would be first the external creditor, then after that the creditor to or the loans to partner. Next, after that, we would distribute any remaining cash to the partner using their capital ratio. And take note for this one, because on our previous, in the financial accounting, we learned that offsetting is not allowed here in the Philippines, but under the liquidation, offsetting is now permitted under the law. So meaning whatever the receivable or loan to partners could now be deducted or added to their capital contributions. Okay? So statement of realization and liquidation, it serves as the guide and summary of the partnership liquidation process. So normally, under the statement of partnership realization, we would see all the visual summary of liquidation. So what are the liquidation expenses? And it also contains all the stating loss realization for the partner as well as the gain. So this also often called a statement of partnership realization and liquidation. Or in some book, it's a realizations of statement of partnership affairs. So this particular statement would show the following: sales of assets. So normally you would see to column, asset to be realized. So these are the existing and asset realized. So the asset realized are those assets that are now contributed to or converted into cash. The division of losses. So how much losses would now be to be absorbed by the partnership and how much gain was able to attain by the partners for this particular transactions. And then what are the payments, or usually you would also see liabilities to be liquidated. So these are the existing creditor and liabilities liquidated, those creditors that are being fully paid. And we also have distribution of cash to partners. So whatever remain after all the assets have been realized into cash and we already paid all the liabilities, then we would now distribute the cash to the partner. So let's take some example. So sales of asset or realization of asset. So these are the partnership attempt to collect all its accounts receivable and non-cash assets are now converted into cash. So expenses in liquidation. So normally in liquidation, it involves additional legal and accounting costs. So you also have costs for disposing the business such as advertising and cost of locating specialized equipment dealers so that you will be able to maximize the selling price. And then the expenses are allocated to partners capital account in P&L ratio because take note, expenses in liquidation since the books are already closed. So we would close all the expenses account into partners capital account. Okay. So let's take an example. So KKR Partnership Limited, balance sheet June 30, 2021. Take note, as previously discussed, we would already close all the income statement account and what was left is the balance sheet account. So we have cash and other assets. So other asset composed of the non-cash assets, 75,000. We need to pay liabilities, 20,000. Loan payable to CAR, 20,000. Kapili Capital, 40,000 and Car Capital, 5,000. So additional information, P&L is divided equally. But in some book, it could be certain ratio. Non-cash asset with a carrying amount of 75,000, realized cash, 45,000. So how much is the loss? 30,000. So let's see. So balance before liquidation, we know that cash is 10,000. Other assets, 75,000. Liabilities, 20,000. Car loan, 20,000. Kapili capital, 40,000. Car capital, 15,000. Realization of other asset at loss, for 30,000 because we sell this other asset from 75,000. We only realize 45,000. And as we said, any loss should now be absorbed by the partnership or by the partner according to their P&L ratio. So 30,000, 50-50 because we said it's divided equally. Then the share of loss of Kapili is 15,000 and Car is also 15,000. So we have now the balance cash 55,000, liability other or non-cash asset is now 0 because we fully realized the 75,000. Liabilities still 20,000, car loan 20,000, Kapili capital 25,000, and car loss negative 10,000. So we pay the creditor first since we still have enough money to pay for the creditor. In the event it's not enough, we would first offset car's deficit from its car loan or receivable from car receivable to the partners. So we had to pay creditor, so 20,000. So less 20,000 from our cash. And then we have liabilities 20,000. So balance would now be cash 35,000. No more non-cash asset, no more liability. Car loan 20,000, Kapili capital 25,000, and car capital was still negative 10,000. Offset car's capital against the loan. So we have now 20,000. So we still have less 10,000 so that car would be able to offset the deficit because deficit is offsetting is now permitted. So balance would now be cash 35,000, car loan 10,000, and then Kapili capital 25,000. Now the balance is now distributed among partner. So the 35,000, 10,000 goes to car for the loan or the capital if you would offset or all the receivable and loan in a simpler computation, then Kapili Capital would now have 25,000 to receive as it's the remaining capital balances. Okay? So let's try another example. What if instead of 45,000, asset is only realized to 15,000? So let's see. So balance would now be cash 10,000. You would see the balance would still be the same. So now the loss in realization, instead of 30,000, it's now become 60,000 because we only realized 15,000. So 60,000. So for Kapili Capital, it's now less 30 and car capital 30. So balance would now be cash 25,000, other assets 0, liabilities was still 20, car loan 20, Kapili Capital 10,000, car 25. So payment to creditor, since we still have enough money to pay for the creditor, so we would have now 20,000 less 20,000 to cash and less 20,000 to liability. So balance would now be cash 5,000. No more other asset, no more liabilities. Car loan was still 20,000. Kapili capital was still 10,000. Car was now negative 25,000. Since we know that offsetting is permitted, we offset the deficit balance of 25 from its loan. So that's now 20,000. So balance would now be cash is only 5,000. No more other assets, no more liabilities, no more car loan. Kapili was still have 10,000. Car was still have negative 5,000. Take note, additional investment, since we say that the partner is still solvent, we would ask car to make additional contribution of 5,000. So that would be debit cash, and then car now will still have 5,000 to cover up for any deficit. So the balance of cash would now be 10,000. No more others asset, no more liability, no more car loan, and car capital is now 0 because she made additional 5,000 investment. So Kapili Capital would have to receive all the cash of 10,000. So let's take an entry. What if it's an insolvent? If it's insolvent, Kapili would now shoulder for any negative balance. So let's make first the entry. So for the selling of the non-cash asset, we receive cash 15,000, Kapili capital 30,000, car capital 30,000, non-cash asset 75,000. Next, for the payment of liabilities, we debit liabilities 20,000 and credit cash 20,000. So since we offset it from car's loan, we debit liability to partner car 20,000 and car capital 20,000. And take note, we know that car was still solvent, so we require car to make additional investments. So that means we receive cash 5,000 and car capital 5,000. Then whatever remain would now be received by Kapili's capital. So we debit Kapili's capital 10,000 and credit cash 10,000. So let's take a look for case number 2. In the event that the partner now become insolvent. So we just focus on that one. So take note, we already offset the balances. So we still have cash 5,000. No more non-other asset, no more liabilities, no more car loan. Partner's capital still have 10,000 for Kapili and car, negative 5,000. But this time, car now is insolvent. So Kapili would now absorb the loss of the insolvent partner. So instead, we would deduct the 5,000 negative balance of car to Kapili. So meaning the balance would now be cash 5,000, car capital is 0, and Kapili capital 5,000. So we would now pay the remaining 5,000 to Kapili, which is 5,000. Okay? So let's take a look of the entries. So for the number 1 entries, it's still the same. For the number 2 entry, it's still the same. For the number 3, it's still the same. But for number 4, it's now different. On our previous slide, it's cash. We debited. But for this one, it's Kapili capital because Kapili capital would now be the one shouldering for the deficit balance of car. Okay? For the number 5 entry, it's still the same. Okay? So, that's it for today. If you like this video, please help me reach out more people by hitting the subscribe and the like button below. God bless you all and keep safe. If you have any questions, just comment. I'll get back to you as soon as I can. Bye! God bless you all!